The biggest fear in America today is running out of money before you die. Next to this, one of the top questions, if I do this, and you fill in the blank, how will it affect my nest egg? How will this affect my future? You might as well ask a financial planner to use a crystal ball, because life's not a straight line. It's not a calculation problem. If it was, everyone would figure it out and everyone could live in a happily ever after story. But people want to retire and live happily ever after. So you have this fascination with financial planners who basically claim the ability to predict the future with calculations and investment strategies. The truth is, financial decisions should not begin from a spreadsheet. In fact, projections can actually be dangerous because results can be extremely different if the assumptions turn out different. And assumptions do often turn out differently, especially when they're relating to the financial markets. Instead of managing risk, many financial planners end up hiding it instead, and they don't even know it. Now, as humans, we tend to anchor on specific numbers, especially nice-looking big numbers. Reality is, when it comes to projections, a range of possible outcomes with a guaranteed foundation, much more valuable than a specific numerical goal that's based on the shifting sand of average market returns. But don't take my word for this. Let's look at the details behind this problem. Then you will know how to manage your finances better, and you will know how far to trust the typical advice you get from advisors in the financial world. I want to share an idea about the black swan. It's an idea, not a bird. There's a book by Nassim Taleb where he develops and explains this idea big time. The link to the book is in the description, and I highly recommend it. Nassim Taleb has been a practitioner of mathematical finance, a hedge fund manager, and a derivatives trader. And applying his strategies during the market crashes in 1987 and the late 2000s, he's made a lot of money. Now, I'm giving Mr. Taleb credit up front because much of the material you'll hear from me here is an echo of his work in an easy-to-understand format. The basic black swan idea is that every now and then an idea, product, or event comes along that almost totally unexpected, that carries huge impact and changes the world in a big way. The term is based on an ancient belief that black swans did not exist, only white ones. Of course, black swans were later discovered, and the old belief became reinterpreted to teach a new lesson. Now, the idea about these black swans is that you don't try to predict them, you just need to be aware of them and manage your finances accordingly. Now, black swans tend to affect us in three different areas. Technology is one, politics is another, and finances is a third. So if we look at examples, these black swan ideas, they can have positive effect or negative effect. So if we look at an example of technology, for example, three things have had a positive black swan effect on technology in the last number of years. You could come up with the computer, the internet, and laser technology. None of these things were predicted by the experts in the industry before they came along. They have definitely changed the way that our world works and what we get to enjoy today. In fact, the computer was so unexpected that Thomas Watson, former president of IBM, I think he's quoted at one point as saying that there was a world market for maybe 5 computers. How ridiculous that seems today. Well, on the other side of the equation, if we look at negative black swan events, there's those types as well. Think Nazi Germany, or 9/11, or the stock market crash of 1929, or even 2008. Now, the point is, these events are not black swans for everyone. Some people were able to see some of those events coming ahead of time. They weren't totally unexpected to them. So, for example, the American Revolution. That was probably a black swan event for the British Empire. Here they are, the masters of world power, and 13 colonies of the United States of America rise up and they force Britain to surrender for one of the first times in years. So these black swan events, they aren't unexpected for everyone. They come in positive, negative cycles here, or effects. And the effect of the potential for an idea can have black swan potential as well. So, for example, if we translate this over to finances, An idea with or an investment with a positive black swan potential could be like writing a new book. You know, the chances are that if it's like a lot of books, it won't ever sell more than a couple thousand copies. But it does have the potential to become a bestseller. It could become a bestseller, right? That's a black swan potential that's positive. Positive black swan potential. Of course, there could be negative black swan potential as well. Think, for example, of lending money to somebody. If they pay you back, your potential, your profit is capped. You're only going to get a certain amount of profit back. But if they don't pay you back, that's the negative black swan potential. And of course, we saw this happen to a lot of banks, financial institutions in the crash of 2008. So these ideas have a positive and negative black swan potential. And Nassim Taleb says, people do not realize that success consists mainly in avoiding losses, not in trying to derive profits. Think about that one for a minute. You know, profits will happen if you're providing value to people. The thing you've got to do is you've got to protect your downside. And of course, that's what many investment products or financial planners try to do. They're trying to do these hybrid investments that protect your downside, they limit your upside in exchange, and they're trying to combine the positive and negative aspects here for a balance. Now, this sounds really nice in theory, but it doesn't work out so great in practice. It's more like trying to drive down the middle of the road, this mountain road that you see here on the screen, and you're getting exposed to traffic from both sides of the road. It doesn't work out so great. We did a podcast here recently that's called, Are You Managing Risk by Hiding It Instead? Don't Let This Bite You. So we'll put the link to this podcast in the resources. You can check that out. But really, all of the risk management, the diversification, the stress testing, the scenario analysis, all of this in the financial world today is based on the same math that they use to figure out and predict the probabilities on games of chance. So gambling games, even just normal games of chance. I mean, even in the textbooks, you read the examples associated with probability and whatnot. All of these are talking about games of chance as examples. It's the same sort of math that's being applied to finances. Does this really work in real life? Well, let's take a look at that here. You see, in games of chance, you can know all the outcomes ahead of time. You know what they're going to be. It's you're not going to have a different set of outcomes if everything is set up fairly. Now, slot machines, you know, if you come to Las Vegas and see these slot machines, they work the same way. In fact, the probabilities on these are already determined before you ever push the button to begin the game. We were at an event one time. I was talking to one of the vendors. He also worked for one of the companies that installed the slot machines at the casinos in Las Vegas. And he was telling us, he said, when you push the button, the machine pings a server in the cloud, and the server comes back with a win or a lose option based on the probabilities that have been predetermined and put into the computer ahead of time. So then the machine's job is just to play it out and make the illusion of choice that you're having there on the machine look like you're actually doing it. Crazy, isn't it? So all of the results are determined ahead of time. And of course, you know, the casino or the house always wins in this type of thing. So when we're talking about games of chance here, you can know all the outcomes ahead of time. That makes the casino business a very good business, right? So if you can manage, keep people from cheating and whatnot, then you've managed your risk. You know what the outcomes are going to be ahead of time as long as you get enough people or gamblers coming into play. So let's look at this example. Steve Wynn here in Las Vegas built the Mirage in 1989. Now, there were 4 events that nearly took that casino underwater in the early years. None of them had to do with the gambling risk. They had that down to a science. They had cameras, they had people walking the floor. They knew how to manage the cheaters. This isn't going to get away from them here. But there were 4 things that were Black Swan events that nearly did take them under. For example, the show Siegfried and Roy. The tiger attacked one of the guys, I think it was Roy, one time. The show ended, and they lost $100 million in the estimated ticket revenues that they were expecting. That's a black swan. How could they have seen that coming? The next thing, Steve Wynn's daughter was kidnapped. He had to pay a $1.4 million ransom. Where did he get the money? From the cash cage at the Mirage. That's not a good idea. I think it was even illegal. But that's where he got the money from. Again, something that could have caused disastrous results for the casino as well. So what else happened? There was a disgruntled contractor that tried to plant dynamite around the pillars that supported the Mirage Hotel. That could have been horrible. And finally, there was a problem with the IRS. You see, when gamblers come in to gamble and you win a certain amount of money, the casino has to file a form with the IRS to report your winnings. Well, at the Mirage, the employee that was responsible for doing this, they created the forms in the computer system, but they never sent them into the IRS. I think they were in a box or something under the employee's desk when they were discovered years later. So an IRS problem on top of all of this. I mean, how could you have predicted anything like this? The casino's models were wonderful at predicting cheating and stopping it, but how can you predict something like this to even be able to plan for it? Again, the answer is you don't try to predict something like this. You just be aware of it. And so you can plan your finances or whatever it is that is exposed to this risk, so you can plan to minimize that. Okay. So did you know that the big name traders, the mutual fund managers in the industry, they don't hire the number crunchers, economists, statisticians. They don't hire these people for their own benefit. No, they're hiring it for the benefit of the investors who are going to buy their fund. And this happens all the way down the line. So the companies that the fund managers are buying their stock, they're crunching numbers for the fund manager to make everything look good so that they'll buy the stock, put it in the fund, right? And the fund manager is crunching numbers so that the investors will invest. And really what they're doing is they're trying to make everything look good in hindsight. And when the market crashes or anything else really big happens, along come the experts, and they can explain everything, but it's always in hindsight. You ever notice that? And hindsight, of course, is always 20/20. It's easy to find reasons in hindsight. The truth is that when it comes to risk management, we cannot know all the possible outcomes ahead of time or how big those outcomes are going to be. That's the key here. It's a major flaw. You cannot use the same math that you use for games of probability and chance to predict this kind of thing. Now, the truth is many experts simply cannot have the foresight to be able to see every problem coming down the pipeline before it arrives. And the problems they don't see tend to be the really big problems that you want to avoid. Take this quote, for example. In all my experience, I've never been in any accident of any sort worth speaking about. I've seen but one vessel in distress in all my years at sea. I never saw a wreck and never have been wrecked, nor was I ever in any predicament that threatened to end in disaster of any sort. This is a famous quote by Captain E.J. Smith of the Titanic. Of course, we know what happened to the Titanic. So when we're talking about all of this, we're programmed to ask the experts on everything that we do, get the advice, then we can make our decision from there. But really, the type of data is the key here. You can't have experts in some types of fields where the data does not conform to averages. So let's look at a few examples here. This comes from Mr. Taleb's book. You can have experts here, he says, on things that don't change. So things like accountants, physicists, insurance analysts, grain inspectors, and livestock judges. The type of data these people are dealing with doesn't change all that much. It's very average data. He calls it mediocre, so it would be from Mediocristan is his term for this. But what about the things that do change? Well, can you really have experts on these things? Stockbrokers, psychologists and psychiatrists, counselors, financial forecasts and personal financial advisors? He says no, you cannot have experts in this because this type of data can be extreme. You can have extreme fluctuations and results you can't predict where it's going to go ahead of time. So how can you have an expert? Now, an expert can have a lot of knowledge in this field about how to do certain things, but they can't predict what's going to happen in the future, what's going to happen even fairly short term. So let's look at an example to make this simple and see why this is the case. Take somebody that's the average height. For a guy, this is 5'9" in the United States. For a lady, it's 5'4". Have you ever met somebody that is 2 times the average height? That means you need to meet a man over 11 feet tall or a lady over 10 feet tall. I've heard of somebody 11 feet tall, but that's, you don't meet these people every day, right? Now, what about, this type of data here is fairly average. You could apply the average mathematics to this, mathematics of averages, and you'll be fairly accurate in all meaningful ways. But let's look at another example. Let's take the average weight of a person, and we'll just look at an average weight for a guy. It's 195 pounds. We'll call it 200 for short. Now let's compare this to the average net worth of the American adult, and let's compare that to the average net worth of Jeff Bezos, the richest man in the world. So the average U.S. adult, their net worth is $301,000. You can see that on the graph here. Jeff Bezos is over $155 billion. He is off the charts. We have to get a new chart here. Now let's put the average U.S. adult on here again. There we are, $301,000. You can barely see that on there. Maybe just turn the line barely orange down there. And here's Jeff Bezos at over $155 billion. I checked these numbers just the other day. He's fairly close. He's within a couple billion of this. But take a look at this. That number is 515,000 times higher. And yet, if you took Jeff Bezos' wealth and you divided it up between all the average American adults here, it's only going to increase the average net worth by about $600. But see, this type of data is subject to extremes. You can have big extremes in the results here. So let's go back to the average weight example. Have you ever met somebody that's 5 times the average weight? 1,000 pounds? I've heard of a guy that was 1,000 pounds. I think he was buried in a piano crate or something, but not very common. You're not going to run across somebody like this every day. What about 10 times the average weight? Have you ever met somebody that weighed a ton? I don't think so. Or what about somebody 515,000 times the average weight? You'd have to meet somebody that's over 103 million pounds. I don't think that's ever going to happen. So on the one hand, you can apply the math of averages to data that is average data. You cannot apply it whenever you're getting into data that can have extreme results. It can throw the average completely off and make it totally meaningless. In fact, you're better planning without it than you are planning with it in some of these things. So that's something that you could think about, whenever in several different areas of life, as you're applying the data that you can see, that you can gather to what you're trying to project the future to be. Now, let's talk about the stock market. Is data in the stock market, is that fairly average data, or is it subject to extremes? Mr. Taleb says, in the last 50 years, the 10 most extreme days in the financial markets represent half the returns. That's pretty extreme, isn't it? And the negative downside is there as well. The 500 largest companies in the United States that were on the S&P 500 in 1957, only 74 were still part of that group 40 years later, 1997. You can see the numbers here represented as a ratio on these bars. The conclusion here is, Mr. Taleb says, I quote from him here, we should learn not to use markets as warehouses of value. They do not harbor the certainties that normal citizens can require in spite of expert opinions. This is an obvious problem with every investment strategy that wholly depends on the financial markets. And this is how most people are planning for retirement. So what's the solution? Now that you know the problem, what should be your strategy? Mr. Taleb says if you know that you are vulnerable to prediction errors, and if you accept that most risk measures are flawed because of the Black Swan, then your strategy is to be as hyper-conservative and hyper-aggressive as you can be instead of being mildly aggressive or conservative. He calls this the barbell strategy. In other words, don't be mediocre. Play full out at everything you do. Get your financial guarantees as guaranteed as possible. Then you can take calculated risks with positive black swan potential in the portion of your portfolio you wish to actively invest. When the rubber meets the road, you really need a separate asset class as your strong foundation where you avoid risk completely. The way we do this is through the guaranteed values in whole life insurance. You see, the risk management in life insurance is based on the type of risk where true averages really count. How long do people live? How tall are they? How much do they weigh? What are the other major correlating factors that contribute to early mortality? These are the type of statistics that life insurance actuaries study and use to design their products. You're never going to have someone that lives 515,000 times more or longer than another person. This makes whole life insurance products that provide real guarantees a good solution for your hyper-conservative financial foundation. The product should be designed to maximize guarantees. And then these guarantees can provide certainty in a way that financial planners focused only on the market can never do. Ever. Period. Most financial planners plan for average results in an extreme market where average assumptions can mean nothing. With life insurance guarantees, you can plan for real, sustainable results in a system where dependable averages afford guarantees, and then any extreme events that come along can open opportunity for you. A truly guaranteed foundation like this allows you more freedom to invest in opportunities with positive black swan potential, because when you have a solid foundation, you know when you're taking risk and you can make the risk taking really count instead of trying to play halfway from the sidelines, always trying to hedge against the hazy risk of unknown magnitude. Our friend Chris Donham says, if you play from the sidelines, you'll look back 30 years from now and say, shoulda, coulda, woulda. When you play full out, you can look back 30 years from now and say, I'm glad I did. Most people in the financial markets today are playing from the sidelines. Don't let that be you. D.L. Moody put it this way, our greatest fear should not be that we won't succeed, but that we will succeed at something that doesn't matter. This is a question you should ask yourself also as you manage your money. So how do you manage your money to avoid black swan risk? Please share your thoughts in the comments below. If you want to explore the option of using whole life insurance as part of your guaranteed foundation, give us a call or schedule a 15-minute intro call with our team using the link below. Because this is where we specialize. If there's potential for you, we'll show you why. If adding life insurance to your strategy is not a good fit, we'll tell you that too. Fair enough? Here's a final tip for you. Whenever you're working with an advisor, be sure to question the strategy they're using to manage risk. If they don't acknowledge the impossibilities of predicting risk that's in the extreme zone, or the faulty methods in managing it, this can be a red flag for you. It would be a good idea to consider how far you will trust their advice. Always ask questions. You can be nice about it, but always ask questions. And don't let a complicated explanation cloud the truth. Truth is usually very simple. Not always easy, but simple. And this is a fact you can use as you exercise your discernment to separate financial truth from all the myths and wishful thinking which are so rampant today. Best wishes to you.